Why do some investors panic when markets fall, while others stay calm and keep investing? The difference often comes down to one word: risk. Understanding investment risk is one of the most important skills an investor can develop. In this video, we'll break down what risk really means, the different types of investment risk, and how Canadians can manage risk more effectively. If you find value in our videos, be sure to like, leave a comment, and subscribe. We post often on personal finance, business ownership, and investing with a Canadian outlook. What is investment risk? Investment risk is the possibility that your actual returns will be different from what you expect. That could mean earning less than planned, or even losing money. Risk is unavoidable when investing because nothing is guaranteed. But risk isn't always bad. In fact, higher potential returns usually come with higher levels of risk. One of the most important concepts in investing is the relationship between risk and reward. Safer investments like high-interest savings accounts or GICs usually offer lower returns. Riskier investments like stocks offer higher long-term return potential, but with more ups and downs, otherwise known as fluctuations. The key is finding the right balance between growth and stability based on your personal situation. Market risk is the risk that the overall market declines. This can be caused by economic slowdowns, rising interest rates, or global events. Inflation risk. Inflation risk is the risk that your investments don't grow fast enough to keep up with rising prices. This is especially important for long-term investors and retirees. Interest rate risk. Interest rate risk mainly affects bonds and fixed income investments. When interest rates rise, bond prices generally fall. Liquidity risk. Liquidity risk is the risk that you can't easily sell an investment when you need cash. Think of real estate. It usually will take months to sell a property before you can get any cash, versus a savings account you can access immediately. Behavioral risk comes from investor emotions. Fear, greed, and panic often cause people to buy high and sell low, the opposite of what they should do. Risk tolerance versus risk capacity. Risk tolerance is how comfortable you feel with market ups and downs. Risk capacity is how much risk you can actually afford to take based on your income, savings, and time horizon. You might feel comfortable taking risk, but if you need the money soon, your capacity for risk may be low. How time affects risk. Time is one of the most powerful tools for managing investment risk. The longer your time horizon, the more time you have to recover from market declines. This is why younger investors can often afford to take more risk than someone approaching retirement. How to manage investment risk. One of the best ways to manage risk is diversification. This means spreading your money across different asset classes, industries, and regions. This means not having all of your investments in US tech companies. That would be a risky strategy because you would have all your money tied to a specific sector in one specific country. Another key strategy is asset allocation, deciding how much to invest in stocks, bonds, and cash. Your allocation should reflect your goals, time horizon, and comfort level. A portfolio of 100% savings and GICs with no risk is considered preservation of capital, meaning there is no chance for downside and only a small upside. A portfolio of 75% fixed income and 25% equities or stocks is considered conservative. A portfolio of 60% fixed income and 40% equities or stocks is considered balanced income. A portfolio of 50% fixed income and 50% equities or stocks is considered balanced. A portfolio of 40% fixed income and 60% equities or stocks is considered balanced growth. A portfolio of 20% fixed income and 80% equities or stocks is considered aggressive. A portfolio with no fixed income and 100% equities or stocks is considered very aggressive. Notice that the further to the right you go on the chart, the more risk you take, but the more your potential return. It's up to you and your financial planner to see where on this chart you and your investments fall and invest accordingly. Finally, Staying disciplined and avoiding emotional decisions can significantly reduce long-term risk. Common investor mistakes. Many investors take too much risk when markets are rising and too little risk after markets fall. Others chase hot investments without understanding the downside. Understanding risk helps you avoid these common and costly mistakes. Risk can't be eliminated, but it can be understood and managed. Successful investing isn't about avoiding risk. It's about taking the right amount of risk for your situation. Be sure to follow our YouTube channel. We post videos about personal finances for Canadians in a simple and easy-to-understand way. For more Canadian investing and financial planning guides, visit financiallywise.ca and subscribe for more simple, practical money tips. Learn more at financiallywise.ca and get our free personal finance app at Financially Wise. See you in the next video.